In this video, we're going to be performing a deep dive on Walmart's dividend safety. To begin, let's talk about Walmart's business model. Walmart traces its roots back to 1945 when Sam Walton opened his first discount store. The company has since grown into the largest retailer in the world, serving 270 million customers each week. Walmart's revenue will be well in excess of $500 billion this year, and the stock trades with a market capitalization of $290 billion. Walmart is a well-known dividend stock because of its compelling track record of dividend growth. With 46 years of consecutive dividend increases, Walmart is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of dividend increases. Looking ahead, investors cannot rely on Walmart's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Walmart's dividend safety in the context of the company's current earnings. When Walmart reported its fourth quarter financial results on February 19th, the company announced that it generated adjusted earnings per share of $1.41 in the 3-month reporting period. For context, the company currently pays a quarterly dividend of 53 cents, which implies a payout ratio of 38% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Walmart generated adjusted earnings per share of $4.91 in fiscal 2019 and distributed $2.11 of common share dividends during the same time period for a full-year payout ratio of 43%. Using earnings, Walmart's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Walmart's current dividend payment to its free cash flow. In fiscal 2019, Walmart generated $27.8 billion of operating cash flow and spent $10.3 billion on capital expenditures for a free cash flow of $17.4 billion. The company distributed $6.1 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 35%. Using free cash flow, our conclusion is the same as when we used earnings to measure Walmart's dividend safety. The company's dividend appears very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Walmart's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Walmart's performance during this time period is shown here. Remarkably, Walmart was actually able to increase its earnings per share each year through the financial crisis of 2007 to 2009. With that in mind, we do not have any concerns about the company's ability to continue paying its dividend during future economic downturns. The last angle that we will use to assess Walmart's current dividend safety is by looking at the company's debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Walmart typically files its 10-K with the Securities and Exchange Commission at the end of March, so the company's formal annual report was not available at the time this video was created. Because of this, we will be relying on the company's debt figures as of the end of the third quarter. At the end of this reporting period, Walmart had $53.7 billion of total debt outstanding, and the company generated $1.4 billion of interest expense through the first 9 months of the fiscal year, for a weighted average interest rate of 3.5%. The following image shows how changes to Walmart's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Walmart's weighted average interest rate would need to rise to about the 25% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Walmart's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.